Oh boy, oh boy, oh boy. You won't believe the data that came out this morning. And there's a reason NVIDIA stocks are moving up. And it's because people are starting to realize, I don't know, man, are small caps, the small business is really the place to be. But beyond that, you got to know what's in this report that just came out this morning. I highlighted so much of it. I feel like I highlighted the whole dang thing. But before we talk about this, I got to talk about AutoZone and what they just said, because it blew my mind. It was mind-blowing. This report, which we'll talk about after AutoZone, by the way, is the report that I traded this morning. I sent an alert to course members right as the data came out. I'm like, going short, and we doubled our option. That's after our first profitable trade of the day on Tesla, and then a second profitable trade that was up almost double. Both 2 out of 2 today. Sweet win. You want to get those alerts, join the Stocks Insight group. And my team told me we got to do a data double flash sale that'll expire tonight at 11:59 p.m. California time. So go check that out if you want to get lifetime access to those courses on building your wealth, trade alerts, and course member live streams. So in our course member live stream this morning, I'll give you a quick preview, but AutoZone, this is crazy. AutoZone was bragging about how they're having revenue growth about 10% year over year. And we're like, well, that doesn't seem that bad. Why is the stock down? Okay, well, is it because of international expansion rather than domestic expansion? And when we get into the weeds, we find that discretionary spending has plummeted in the United States. Do-it-yourself spending has plummeted in the United States. And the company is so frustrated that they can't pass on any price increases that they're essentially begging for inflation to come back. They're like, we're looking forward to some inflation so we can raise prices, which would then increase revenues and bring us back to growth. In the same vein, while they realize they can't, they're starting to talk about right-sizing staffing. And that's all, I mean, we all know this. This is a euphemism for layoffs that are coming. It's a big, big problem. And folks, it's basically exactly what the Consumer Conference Board is warning about. But to hit the nail on the head here, when AutoZone is telling you, hey, we're growing in Brazil and South America, and we're just going to focus on international stores, and we'll eat the currency headwinds, which are massive. Let's just ignore the U.S. consumer because things are really bad right now. Well, it's basically what the September Consumer Confidence Board report says. This is nasty. Again, I highlighted a lot of this, sorry, but listen to this. Consumer confidence weakened as consumers worry about jobs. We realize anytime we get bad news about jobs going forward, we are in a low liquidity, high volatility environment. What that means is stocks can move extremely rapidly. This morning we saw the 10-year bond yield, bear steepening again, up 6 basis points thanks to China's stimulus bazooka. But what people forget is in a recessionary environment or a slowdown in jobs, what we actually get is called a bull steepening. The yield curve goes from positive, where it is now 10, 20 basis points, to positive 50, to positive 90. But that's the beginning of the recession. Not now. When we're at 50 or 90, we're walking towards that number. Every single time we've gone from inverted to positive 50 to 100, we've been in a recession. We are screaming towards that. And any bad data on jobs is just going to reiterate that. The stock market will move on that. I think that's why, in part, yes, obviously the Chinese stocks are doing well today because of the stimulus bazooka of yesterday. I don't think that'll actually be enough to spur consumers. I think consumers will be like, cool, I'm going to take profits now and not continue to trust the Chinese government. But anyway, what happens in America is people probably go towards higher cash flow companies at first, back into the safer, like Morgan Stanley's Mike Wilson says, mega caps like NVIDIA's. I actually don't think NVIDIA's valuation is too horrible, as long as they can hold up their growth, which so far it seems like they can. But listen to this report, it's crazy. The Consumer Confidence Board Confidence Index fell in September to 98.7. This is a low, by the way. Consumer confidence dropped in September to near the bottom of the narrow range that has prevailed over the last 2 years. So basically the lowest in the last 2 years. September's decline was the largest since August of 2021, and all 5 components of the index deteriorated. That's how they measure, where the spending is happening for consumers. And remember, folks, the consumer makes up 70% of our economy. More, some people say 72%. So consumer weakening, whether it's consumer goods or services, very, very, very bad. So September's decline was the largest since August of 2021. All 5 components deteriorated. consumer assessments of current business conditions turned negative, while their views of the current labor market situation softened further. Consumers were also more pessimistic about the future labor market conditions available and less positive about future business conditions. The drop in confidence was the steepest for consumers 35 to 54. Now, what's fascinating about that age was just entering the job market or barely in the job market during the 2008 recession. So when you have 35 to 54-year-olds who lost the most confidence because they're worried about recession, they're thinking back to 2008. And rightfully so. That's a smart thing to do. Listen to those. Those who had the most confidence were consumers under 35. Basically people who were in high school, middle school, or elementary school during the Great Recession. So they don't have the memory of the pain. They only have the market opinion of buy the dip, everything's gonna go up. Confidence declined in September across most income groups, with consumers earning less than 50K experiencing the largest declines, and the 6-month moving average for consumers of over 100K remaining most confident, but obviously also declining. Hold on a sec, let's give this a little move here. I gotta turn the page. Okay, there we go. Deterioration across the indices' main components likely reflected consumers' concerns about the labor market and reaction to fewer hours being available, slower payroll increases, fewer job openings, even if the labor market remains quite healthy with low unemployment, few layoffs, and elevated wages. The proportion of consumers anticipating a recession over the next 12 months remained low, but saw a slight uptick. So let's try to distill this. What you're seeing is consumers who have lived through a recession are getting more nervous, substantially more nervous. The worries across all of them, yes, in part, are still to some degree higher prices, because they also survey in this report that I've read, and just gonna bottom line you on some of it. They talk, yes, high prices are still an issue, because even if we have disinflation, prices are still so high until we really have deflation. But what's most concerning for people is their concerns over, wait a minute, what happens if we lose our job and then we can't get another one? Look at the percentage of people who have been unemployed for more than half of a year. Google this one. St. Louis Fred, with an R, like your buddy Fred, 27 weeks unemployed. The only time that number goes up is in a recession. Go look to see what it's doing now. Anyway, these are people who are worried about not seeing increases in their pay to try to catch up with higher prices. They're worried about seeing fewer job openings. They're worried about seeing hours cut at jobs that they're working or companies they're working for. Maybe they're even seeing quiet layoffs around them. This is something else to keep in mind. Companies like IBM and Amazon and this sort of like, oh yeah, force everybody back to work. Even Salesforce did it. It's just a way of quietly firing people, right? Because you're going to lose people through attrition. But no company wants to be the first company to say, oh yeah, we're doing layoffs. Because as soon as you do, guess what happens? Your stock tanks and then you're the loser. But if everybody lays off during a recession, it's okay, it's just a recession. So this is some really bad data. The Richmond Fed Manufacturing Index also came in at like -24 versus the -12 expected. I can't remember that number exactly, but it was also bad. That's why I threw in the trade. That's why I sent an alert to people in the Stocks Insight group. And I always like to say, past performance doesn't guarantee future results. We always try to do our best. Obviously, if we can do well trading off data like this in the morning, the goal is to do it again. But again, can't guarantee that you'll make money. We'll always want to be transparent about that. I'm just going to keep every single day providing value to you. I'd love for you to be part of the course member live streams. You can come any day. You can watch the replays on them on days that you're interested in seeing what my opinion is. Or for all those of you in the second wave of inflation camp, you really got to ask yourself, are you reading earnings calls? Are you seeing what the auto zones are saying? Are you seeing what companies are saying that say, look, we are facing deflation, not inflation? Ask yourself that. We do it in the course member live streams almost every single day. Anyway, we'll end that flash sale tonight at 11:59 p.m. automatically. If you have questions, email staff@mekevin.com. And for the last of you still remaining here, if you want actual personalized financial advice, go to stockhack.com. It's live. Thanks so much. We'll see you soon. Bye.